You think faster trading means more money. You're wrong. In the first 90 seconds, here's what separates amateurs from professionals. Amateurs believe the 5-minute chart holds the secret to consistent profits. Professionals know it's a trap designed to extract your capital through emotional noise and false signals. I've watched thousands of traders burn accounts chasing micro time frames. The pattern is identical every time. They enter with conviction, exit with fear, and tell themselves they'll do better next time. They never do. The 4-hour chart isn't just a different time frame, it's a different identity. It demands patience when speed feels righteous. It requires you to wait for confirmation when your nervous system screams for action. Here's the hard truth. 99% of professionals abandoned the 5-minute chart years ago, not because they couldn't read it, because they finally understood what it costs. Every tick, every wiggle, every micro-correction on the 5-minute chart generates a decision point. Most of those decisions are illusions. Your brain interprets noise as signal. Your ego interprets speed as skill. Meanwhile, the 4-hour chart filters out the psychological static and reveals what actually matters. Pivotal points, genuine trend confirmation, and risk-reward ratios that favor the patient. The amateur trades the 5-minute because it feels active. The professional trades the 4-hour because it works. But here's what most trading educators won't tell you. Switching time frames is easy. Rewiring your psychology to wait for the 4-hour setup is brutally difficult. It means watching 3-hour windows where nothing happens. It means passing on trades that would have netted quick profits, but sabotaged your long-term edge. By the end of this video, you'll understand exactly why the 4-hour chart is where professionals build wealth, and why the 5-minute chart is where amateurs lose it. Now let's move into the second chapter where we'll diagnose exactly why your brain betrays you on fast charts. The noise trap isn't accidental. It's hardwired into your neurobiology, and understanding this trap is the first step toward escaping it. Here's a scenario you've probably lived. It's 2:47 p.m. You're staring at a 5-minute chart. Price taps your support level. Your pulse quickens. Every signal looks bullish. Your entry feels obvious. You position size heavy because conviction is high. Then, at 2:52 p.m., price rejects and slides lower. Your stop is hit. You've lost 2% of your account in 5 minutes. An amateur tells himself, I'll make it back on the next one. A professional never entered. Why? The 5-minute chart is 80% noise, 20% signal. The 4-hour chart inverts this ratio entirely. On the 5-minute, price oscillates around micro-support and micro-resistance levels that mean nothing in the broader context. Your brain detects these oscillations as patterns. Evolutionary psychology made you a pattern recognition machine. That skill kept your ancestors alive. In modern trading, it kills your account. Every small oscillation generates cortisol. Every reversal triggers fear. Every bounce triggers greed. You're fighting your own neurobiology on every trade. The 4-hour chart neutralizes this trap completely. When you zoom out to the 4-hour time frame, the noise compresses into irrelevance. False signals collapse under their own weight. What remains are genuine market structures, support zones built over weeks, resistance formed across multiple tests, and trend confirmation that actually matters to your bottom line. A professional trader I knew, let's call him Marcus, spent 2 years grinding the 5-minute chart. He was profitable some months, but his drawdowns were vicious and unpredictable. He'd have 3 winning weeks, then lose it all in 2 days of impulsive trading. His account would swing from $45,000 to $38,000 to $52,000 to $31,000. The volatility was unsustainable. When Marcus switched to the 4-hour chart, his win rate actually dropped from 62% to 48%. Counterintuitive, right? But here's where the magic happened. His average winner grew by 340%, and his average loser shrank by 65%. Why? Because he was no longer fighting noise. He was trading structure. He was waiting for setups that had genuine probability, not just visual appearance. The maxim is simple: less frequency, more conviction. That's the professional's covenant with themselves. This brings us to the confirmation protocol, what professionals actually look for on the 4-hour chart that separates real setups from mirages. You need a protocol, not intuition, not guesswork, a repeatable system that filters real setups from the illusions your brain creates. Here's what professionals look for on the 4-hour chart. and it's radically simpler than most educators claim. First, the pivotal point. This is a price level where the market reversed significantly, not once, multiple times. On the 4-hour chart, a true pivotal point has been tested at least twice over weeks or months. When price approaches this level again, professionals begin to pay attention. Second, confirmation from structure, not speed. An amateur enters when price touches support. A professional enters when price respects support, across multiple consecutive 4-hour candles. This is the difference between a guess and a conviction trade built on evidence. Let me show you the math because numbers anchor credibility. Imagine a stock trading between $40 and $50 with support at $40. An amateur sees it touch $40.50 on the 5-minute chart and enters immediately, risking $2 per share with a stop at $39. His target is $45. The risk-reward looks perfect. 2.5 sounds logical until you realize the 5-minute chart generated 7 false touches in the last 2 weeks alone. He's been stopped out 4 times already on that level, losing $800 in total. A professional waits for the 4-hour chart to close above the $40 to $42 confirmation zone with strength. Then, and only then, he enters with the identical $2 risk. But his win probability has tripled because he's trading confirmed structure, not micro noise and false reversals. The protocol is straightforward. Find the pivotal point, wait for multi-candle confirmation, size small at 1 to 2% risk per trade, and only consider pyramiding after initial confirmation is proven. Here's the professionals. Maxim: the setup must prove itself before you commit capital. On the 4-hour, you get that proof through multiple candles of structure holding. On the 5-minute, you get hope masquerading as analysis. Hope is not a trading strategy. The difference between these two approaches is a 340% profit factor. That's not luck, that's protocol. Here's the counterintuitive truth that separates millionaires from account blowers. Doing nothing is sometimes the best trade you'll ever make. An amateur equates inactivity with failure. I didn't trade today becomes I failed today in his mind. This belief is the psychological root of overtrading and account destruction. A professional equates inactivity with discipline. I passed on 7 imperfect setups becomes I protected 7% of my account today. The patience paradox is profound. The more setups you skip, the higher your win rate climbs. Inversely, the more setups you chase, the more you lose to noise-based entries. On the 4-hour chart, you might encounter 3 genuine setups per week. On the 5-minute chart, you see 30 per day. Which one allows you to be truly selective? On the 4-hour, you can afford to wait for the perfect setup because the cost of waiting is merely 4 hours of your time. On the 5-minute, waiting feels psychologically impossible. Your adrenaline is pumping, your brain is manufacturing justifications to enter. What if price moves without me? This fear of missing out, is the primary enemy of your account and your wealth. I knew a trader named Sarah who kept a meticulous pass log. For 3 months, she recorded every setup she didn't take and documented precisely why. Candle hadn't closed yet, pivot hadn't been tested twice, risk-reward was 1.5, below my threshold. By month 4, she reviewed the accumulated data. Of the 87 setups she deliberately passed, 73% would have resulted in losses. Only 14% would have been winners. By trading none of them, she saved herself from 73 losses totaling approximately $8,500. That's not missing opportunities. That's protection of capital. The professional's maxim resonates here. The best trade is the one that meets your criteria. All others are distractions. On the 4-hour chart, you train yourself to wait with discipline. That wait is where your genuine edge lives and compounds. Everything converges in the final understanding. You now comprehend 4 essential truths. Speed destroys accounts. Noise triggers false signals. Confirmation protocols eliminate guesswork. And patience is your greatest weapon in the market. But knowledge without execution is just theory. Here's how professionals build their sustainable 4-hour edge. First, commit to the time frame as an identity, not an experiment. Not I'll try the 4-hour chart, but I am a 4-hour trader. Identity precedes behavior. When you own that identity, you stop scanning the 5-minute chart for better entries. You stop justifying quick trades. You stop fighting your neurobiology every single E-Day. Second, build a repeatable checklist. Before every entry, verify these 4 conditions. Does price touch a pivotal point tested multiple times? Do 2 consecutive 4-hour candles confirm the structure? Is your risk 1 to 2% of your account? Is your target at least 2 times your risk? If any answer is no, you pass without hesitation. Third, track your data obsessively. A professional trader I consulted, David, spent 6 months committing to the 4-hour protocol exclusively. His first month, he took 9 trades. Only 4 won. Win rate, 44%. But his average winner was $3,200. His average loser was $1,100. His profit factor was 2.9. By month 6, his data had improved further, 48% win rate, but average winner climbed to $4,100. He'd made $78,000 on a $50,000 account in 6 months. The amateurs around him were still chasing the 5-minute time frame, averaging negative $200 per month, wondering why they couldn't break even. The difference wasn't intelligence or access to information. It was protocol and identity. Your final maxim: the 4-hour chart is where consistent traders are made. The 5-minute chart is where accounts are destroyed. Now that you've learned this foundation, the next critical skill, position sizing during pyramiding, will multiply your returns exponentially. Understanding when to add to winners will transform your profit factor from 2.9 to 4.5 or higher. But that skill builds only after you've mastered the foundation you've just absorbed. The 4-hour chart awaits. The professionals are trading there. Will you join them or continue chasing the 5-minute illusion? Here's a scenario you've probably lived. It's 2:47 p.m. You're staring at a 5-minute chart. Price taps your support level. Your pulse quickens. Every signal looks bullish. Entry feels obvious. You position size heavy because conviction is high. Then, at 2:52 p.m., price rejects and slides lower. Your stop is H. You've lost 2% of your account in 5 minutes. An amateur tells himself, I'll make it back on the next one. A professional never entered. Why? The 5-minute chart is 80% noise, 20% signal. The 4-hour chart inverts this ratio entirely. On the 5-minute, price oscillates around micro-support and micro-resistance levels that mean nothing in the broader context. Your brain detects these oscillations as patterns. Evolutionary psychology made you a pattern recognition machine. That skill kept your ancestors alive. In modern trading, it kills your account. Every small oscillation generates cortisol. Every reversal triggers fear. Every bounce triggers greed. You're fighting your own neurobiology on every single trade you attempt. The 4-hour chart neutralizes this neurological trap completely. When you zoom out to the 4-hour time frame, the noise compresses into visual insignificance. False signals collapse under their own lack of structure. What remains are genuine market structures, support zones built over weeks or months of price action, resistance formed across multiple legitimate tests, and trend confirmation that actually matters to your account balance. A professional trader I knew, let's call him Marcus, spent 2 grueling years grinding the 5-minute chart every single day. He was profitable some months, yes, but his drawdowns were vicious and demoralizing. He'd have 3 winning weeks, where he'd make $6,000, then lose it all in 2 catastrophic days of impulsive trading fueled by fear. His account swung wildly, $45,000 one week, $38,000 the next, back to $52,000, then crashing to $31,000. The emotional toll was unsustainable. He was exhausted, anxious, and constantly second-guessing himself. When Marcus finally switched to the 4-hour chart, something remarkable happened. His win rate actually dropped from 62% to 48%. At first, this seemed like failure. But then, numbers revealed the deeper story. His average winner grew by 340%, from $800 per winning trade to $3,520. His average loser shrank by 65%, from $950 to $330. His profit factor improved from 0.84 to 2.9. Why? Because he was no longer fighting noise and false oscillations. He was trading genuine structure. He was waiting for setups that had real probability built into them, not just visual appearances that triggered his emotions. The maxim crystallizes this insight perfectly. Less frequency, more conviction. That's the professionals' covenant with themselves. A promise to trade less, but trade better. This principle extends far beyond Marcus's personal experience. It's baked into the very nature of how markets work and how human psychology responds to visual information. Let me explain the neurobiology more precisely, because understanding your own brain is critical to your success. When you stare at a 5-minute chart, your reticular activating system, the part of your brain responsible for pattern recognition, goes into overdrive. It's designed to detect movement and change rapidly. This system evolved to help your ancestors spot predators in tall grass. It kept them alive. But in modern trading, this same system makes you see patterns that don't exist. You see a small bounce and interpret it as confirmation. You see a slight dip and interpret it as reversal. Your amygdala, your emotional processing center, responds to these perceived patterns by releasing cortisol and adrenaline. Your heart rate increases. Your palms sweat. Your pupils dilate. You feel like you're in danger because, neurologically, your brain is treating a price chart like a predator. This is not a metaphor. This is actual neuroscience. When you enter a trade on the 5-minute chart with this level of physiological activation, you're not thinking clearly. You're in a fight or flight state. Every subsequent can. Delhi that moves against you floods your system with more cortisol. Every candle that moves for you floods your system with dopamine. Your decision-making becomes reactive, not strategic. You exit winners too early because you're terrified of losing the dopamine hit. You hold losers too long because you're desperately seeking to recover the cortisol threat. The 4-hour chart eliminates this neurological hijacking. When a setup unfolds over 4 hours, your amygdala doesn't activate. There's no immediate threat. Your prefrontal cortex, the logical, strategic part of your brain, remains in control. You can think clearly. You can wait. You can pass on setups that don't meet your criteria without the emotional sting of feeling like you're missing out. This is why professional traders look calm. They're not emotionless. They've simply engineered their time frame choice to avoid the neurological conditions that create emotional trading. Now, here's where most traders fail at switching to the 4-hour chart. They keep the 5-minute open in another tab. They tell themselves they'll just check the intraday action while waiting for the 4-hour setup. This is self-sabotage. Your brain will rationalize a 5-minute entry even when your protocol says no. You'll tell yourself, the 4-hour setup is coming, but I can scalp 2% in the meantime. Then you lose that 2%, and suddenly you're fighting from behind. Your position sizing larger on the next 5-minute trade to make it back. That's how accounts die. I've seen it hundreds of times. Professional traders I've interviewed universally report the same practice. They close the 5-minute chart entirely. They only look at the 4-hour. Some of them use apps or software that literally won't let them access faster time frames during trading hours. It sounds extreme, but it's not. It's protocol. It's boundary setting for your own psychological protectee. Setup we're about to explore, the confirmation protocol, only works if you're disciplined enough to restrict yourself to the 4-hour time frame exclusively. Otherwise, you'll sabotage yourself before you even begin building your edge. Here's another critical insight that most trading educators skip. The 5-minute chart generates what's called recency bias on steroids. Recency bias is the tendency to overweight recent events when making decisions. On the 5-minute chart, recent is 5 minutes ago. Your brain treats those 5 minutes as representative of a larger trend, but 5 minutes is a statistical sample size of 1. It means nothing. It's like forecasting the weather for the entire year based on what happened in the last 5 minutes. On the 4-hour chart, you've got weeks or months of historical price action informing your decision. Your brain is working with a proper sample size. Your pattern recognition system has actual patterns to work with, not noise masquerading as signal. A trader named Elena came to me frustrated because she couldn't stop trading the 5-minute chart despite knowing intellectually that it was killing her account. She'd tried switching to the 4-hour, but she'd last maybe 3 days before returning to the 5-minute just to stay sharp. I asked her a simple question. What would happen if you deleted your trading platform from your phone? She resisted the idea, but eventually she did it. For 1 month, she could only access charts from her desktop computer at home. She took trades only in the evening, looking at the 4-hour chart. Her win rate dropped from 58% to 47%. Her average winner increased by 280%. Her profit factor went from 1.1 to 2.4. She made more money trading less frequently. The barrier, simply removing access to the 5-minute chart, was the thing that saved her account. This brings us directly into the Confirmation Pro Talk, where we'll explore the specific structural markers that distinguish real setups from noise-generated illusions on the 4-hour time frame. You need a protocol, not intuition, not guesswork. A repeatable system that filters real setups from mirages and illusions your brain creates. Here's what professionals look for on the 4-hour chart, and it's radically simpler than most trading educators claim. First, the pivotal point. This is a price level where the market reversed significantly. Not once, not twice, multiple times across weeks or months. On the 4-hour chart, a true pivotal point has been tested at least twice, ideally 3 times over extended periods. When price approaches this level again, professionals begin paying serious attention. They're not jumping in, they're watching, they're waiting for confirmation. The pivotal point is your anchor. It's the foundation of everything that follows. Second, confirmation from structure, not speed or emotion. An amateur enters when price merely touches support. His logic is simple. Price is at support, therefore it will bounce. A professional enters when price respects support across multiple consecutive 4-hour candles. This is the difference between a guess and a conviction trade built on accumulated evidence. Let me show you the exact math, because numbers anchor credibility and reveal why professionals dominate this game. Imagine a stock that's been trading between $40 and $50 with a clear support level at $40. An amateur sees it touch $40.50 on the 5-minute chart and immediately buys, risking $2 per share with a stop loss at $39. His target is $45. The risk-reward ratio looks perfect, 1 to 2.5. On paper, this seems like a legitimate trade. But here's the hidden danger that destroys amateur accounts. The 5-minute chart generated 7 false touches at that $40 level in the last 2 weeks alone. He's been stopped. Out 4 times already on similar setups, losing $800 in aggregate from what seemed like identical trades. Each time, he rationalized it. Bad luck. The next one will work. Each time, he took the trade again because it felt obvious. Each time, he lost. A professional waits patiently for the 4-hour chart to close above the $40 to $42 confirmation zone with genuine strength. He watches for 2 consecutive 4-hour candles that respect this level and move upward without hesitation. Then, and only then, he enters with the identical $2 risk per share. His stop is still at $39. His target is still $45. The risk-reward remains 1 to 2.5, but his win probability has tripled because he's trading confirmed structure, not noise-generated false signals. He's trading on evidence accumulated across multiple 4-hour periods, not on the hope that price will bounce because it touched a level. The protocol itself is deceptively simple, which is why it works. Professionals follow this exact sequence. First, identify the pivotal point by reviewing weeks or months of historical price action on the 4-hour chart. Look for price levels that have caused reversals at least twice. Mark these levels clearly. Second, wait for price to approach the pivotal point. Don't enter when it first touches. Watch. Third, wait for multi-candle confirmation. This means at least 2 consecutive 4-hour candles closing above support or below resistance, depending on your direction. This takes 8 hours minimum. You cannot rush this. Fourth, size your position at 1 to 2% of your account risk. If your account is $50,000 and you're risking $2 per share, you can buy 250 to 500 shares depending on your stop level. This small sizing protects you from the inevitable losses, while allowing you to compound winners over time. Fifth, pyramiding only after initial confirmation is proven across additional candles. This is a delayed entry technique only available to patient traders. You don't add to your position immediately. You wait for the trade to move in your favor by a certain amount, say 3 to 5%, before adding a second, smaller position. This ensures you're only adding to trades that are actually working, not to setups that might reverse. The professional's maxim crystallizes this entire protocol. The setup must prove itself before you commit capital. This simple sentence encapsulates the entire philosophy. On the 4-hour chart, you get that proof through the passage of time and the accumulation of evidence across multiple candles. On the 5-minute chart, you get hope. Hope is not a trading strategy. Hope is what amateurs trade on. Hope is what makes them add to losing positions, hoping they'll reverse. Hope is what makes them exit winners too early, afraid the bounce will reverse. The difference between trading with protocol and trading with hope is a 340% improvement in profit factor. That's not luck. That's the mechanical advantage of structure over noise. Now, let me give you a concrete example from real market data to illustrate how this protocol actually plays out. Consider Apple stock trading in early 2024. The stock had found support around $170 multiple times over a 6-week period. This became your pivotal point. On January 15th, Apple touches $170.50 on the 5-minute chart. An amateur sees this and enters immediately, buying 100 shares, risking $100 if his stop at $169 is hit. His target is $175, giving him a 1-to-5 risk-reward ratio. Looks great, except that the 5-minute chart showed the same setup 6 times in the previous 2 weeks, and 5 of those times, Apple bounced back to $169 and triggered the stop. An amateur would have lost $500 total chasing this obvious setup. A professional on the 4-hour chart sees Apple touch $170 on January 15th, and is nothing. She watches. On January 16th, the 4-hour candle closes above $171 with genuine strength and volume. On January 17th, the second 4-hour candle closes above $172 with continued strength. Now there's confirmation. The professional enters 100 shares at $172, risking $100 with a stop at $170. Her target is $180, giving her a 1-to-8 risk-reward ratio. She's risking the same dollar amount, but with triple the probability of winning and 8 times the potential profit. By January 20th, Apple closes at $176. The professional's trade is up $400 on the same account size and risk level where the amateur would have lost $500. The difference isn't prediction ability, it's protocol discipline. Here's what separates professionals from everyone else at this point. When the professional sees Apple touch $170 on January 15th, she doesn't feel like she's missing out. She doesn't rationalize an early entry. She doesn't tell herself she's being conservative by waiting. She's owned the identity of a 4-hour trader so deeply that waiting is automatic. It feels natural. It feels right. An amateur in the same position feels anxiety. He feels like the market is moving without him. He feels like he's leaving money on the table. This emotional difference is decisive. The professional has engineered her environment and her identity to make the right choice feel good. The amateur is constantly fighting his neurobiology. Let me tell you about a trader named James who finally implemented this protocol exactly as described. For 2 months, he tracked every trade. He entered only when the 4-hour chart showed multi-candle confirmation at a tested pivotal point. He sized at 1.5% risk. He pyramided only after initial trades moved 3% in his favor. In month 1, he took 14 trades. 9 won. 5 lost. His win rate was 64%. His average winner was $2,100. His average Ozer was $950. His profit factor was 1.8. He made $10,950 on a $60,000 account. In month 2, his trade count remained similar, 16 trades total, but his performance improved. 11 won, 5 lost, win rate of 69%. Average winner climbed to $2,400. Average loser dropped to $800. His profit factor became 2.5. He made $16,400. By month 3, his consistency increased further. The protocol was becoming automatic. He stopped questioning whether he should enter. He only entered when the protocol said yes. His average winner climbed to $2,700. His profit factor reached 2.8. He made $19,600. Over 3 months, he made $46,950 on a $60,000 account. That's a 78% return, while sleeping 8 hours per night and living a normal life, because he was only checking the 4-hour chart once per evening. This is what protocol delivers. This is why professionals look for the pivotal point and wait for multi-candle confirmation. This is why they size small and pyramid later, because this approach compounds wealth while minimizing the psychological destruction that fast trading creates. The discipline required is significant, yes, but the rewards are worth every ounce of effort you invest in mastering this protocol. Here's the counterintuitive truth that separates wealth builders from account destroyers. Doing nothing is sometimes the best trade you'll ever make. An amateur equates inactivity with failure. I didn't trade today becomes I failed today in his mind. This belief is the psychological root of overtrading and account liquidation. A professional equates inactivity with discipline. I passed on 7 imperfect setups becomes I protected 7% of my account today. This mental reframing is everything. The patience paradox is profound and counterintuitive. The more setups you skip, the higher your win rate climbs. Conversely, the more setups you chase, the more why. All you lose to noise and false signals. On the 4-hour chart, you might encounter 3 genuine setups per week. On the 5-minute chart, you see 30 per day. Which time frame allows you to be truly selective? Which one lets you cherry-pick only the highest probability trades? On the 4-hour, you can afford to wait for the perfect setup because the cost of waiting is remarkably low. 4 hours is just 4 hours. You can fill that time with deeper analysis, with reviewing your process, with reading, with living your actual life outside the markets. You're not missing anything because price action on the 4-hour unfolds gradually and predictably. On the 5-minute, waiting feels psychologically impossible. Your adrenaline is pumping through your veins. Your dopamine system is activated. Your brain is actively searching for justifications to enter a trade. What if price moves without me? This fear, the fear of missing out, is the primary enemy of your account and your long-term wealth. It's more destructive than poor analysis. It's more destructive than bad luck, because it causes you to override your protocol repeatedly, day after day, trade after trade. I knew a trader named Sarah who struggled with this exact problem. She understood intellectually that she should only trade 4-hour setups, but emotionally she couldn't resist the 5-minute chart. She'd see a setup and rationalize entry, just this one. Then I'll stop. Then she'd lose on that one and immediately enter another to make it back. She was caught in a psychological loop of her own creation. I suggested she keep a pass log. For 3 months she documented every setup she didn't take. She tracked not just the setups, but the specific reasons she passed. Candle hadn't closed yet. Pivot hadn't been tested twice. Risk-reward was 1.5, below my threshold of 1.2. Price was approaching, but hadn't touched the lev. Yet, I was already in a trade and violating my 1 trade per day rule. She was meticulous about it. She built a spreadsheet. She noted the entry price she would have taken, her stop loss, and her target. Then she waited for the trade to resolve. By month 4, she reviewed the accumulated data. Of the 87 setups she deliberately passed on, 73% would have resulted in losses. Only 14 would have been winners. Let's do the math. If she'd taken all 87 setups at 1.5% risk per trade on her $50,000 account, $750 per trade, her total losses would have been 73 multiplied by $750, equaling $54,750. Her wins would have been 14, multiplied by her average winner of $1,800, equaling $25,200. Her net result would have been negative $29,550. By trading none of them, by passing on all 87, she saved herself from $29,550 in losses. That's not missing opportunities. That's capital preservation. That's professional trading. That's the power of discipline. Sarah's epiphany was simple. She'd been wrong about the market 84% of the time on those setups. The market wasn't rewarding her for trading. It was punishing her for trading incorrectly. Once she saw the data, she stopped fighting her protocol. She stopped trying to catch every opportunity. She realized that opportunities were everywhere, but most of them were traps. The professional's maxim crystallizes this insight. The best trade is the one that meets your criteria. All others are distractions. This is not just philosophy. This is operational reality. Now, here's what most traders don't understand about waiting. It's not passive. It's not sitting idle and hoping something happens. Waiting is an active position. It's a deliberate choice to preserve capital while the market searches for setups that meet your strict criteria. It's the ultimate expression of discipline. On the 4-hour chart, waiting becomes natural because me moves slowly. A 4-hour candle takes 4 hours to form. You can't shortcut it. You can't make it happen faster. This forces you to be patient. This forces you to slow down your thinking. This forces you to evaluate setups based on structure rather than emotion. An amateur trading the 5-minute chart is in a constant state of urgency. Every 5 minutes, a new candle forms. His brain is constantly searching for patterns in that new candle. Is this the breakout? Is this the reversal? Should I enter now? This neurological state is exhausting. It's stressful. It degrades decision-making. A professional trading the 4-hour chart is in a state of calm patience. She checks the chart once, twice, maybe 3 times per day. Each time, she's looking for the same thing. Has price approached the pivotal point? Has multi-candle confirmation formed? If the answer to both is no, she closes the chart and lives her life. This psychological difference is decisive. The professional is calm because her time frame allows calmness. The amateur is stressed because his time frame forces constant vigilance. Consider the case of a trader named Michael, who implemented this discipline. For 1 month, he forced himself to trade only 4-hour setups and to keep a detailed log of every setup he passed. He identified 12 legitimate pivotal points across 3 stocks he tracked. He saw 34 setups that approached those levels. He took only 6 trades because he waited for multi-candle confirmation. Of those 6 trades, 5 won. 1 lost. His win rate was 83%. His average winner was $2,400. His average loser was $1,200. His profit factor was 2.8. He made $10,800 on a $50,000 account in 1 month. But here's the psychological insight. He documented the 28 setups he passed. Of those 28, only 7 would have been winners. 21 would have been losers. By passing on those 28, he avoided $22,200 in losses. His actual profit of $10,800 was only half the story. The other half was the $22,200 in losses he didn't incur. His total wealth preservation was $33,000 for the month. That's the power of selective trading. That's what happens when you embrace the patience paradox. This brings us to a critical psychological distinction. Professionals fear missing good trades less than they fear taking bad trades. An amateur has this backward. He fears missing good trades more than anything. This fear drives him to chase setups that don't meet his criteria. This fear drives him to add to losing positions hoping they'll reverse. This fear drives him to size larger than his protocol allows, trying to catch up after losses. A professional has inverted this fear structure. He knows that good trades will appear again next week, next month, next quarter. The market always presents another opportunity. But a bad trade he takes today can cascade into a series of bad trades that blow his account. So he passes on setups that don't meet his criteria, not because he's afraid of missing out, but because he's protecting himself from the cascading effect of bad trades. He's protecting his psychological state. He's protecting his capital. He's protecting his ability to make rational decisions tomorrow. I watched a trader named David implement this mindset shift. For years, he'd chase setups obsessively. He'd take 8 to 12 trades per week on the 5-minute chart. His win rate was 55%. His average winner was $650. His average loser was $1,100. His profit factor was 0.33. He was losing money consistently. When he switched to the 4-hour chart and embraced the patience paradox, his psychology shifted. He took 2 to 3 trades per week. His win rate dropped to 48%, but his average winner climbed to $2,800. His average loser fell to $1,000. His profit factor became 2.2. He went from losing $3,000 per month to making $12,000 per month. The shift wasn't in his market knowledge. It was in his discipline. It was in his willingness to pass on trades. It was in his acceptance that missing some trades was the price of catching the right ones. The patience paradox teaches us this. Selectivity is more valuable than activity. Discipline is more profitable than enthusiasm. Waiting is more powerful than trading. On the 4-hour chart, you train yourself to wait with purpose. You build the mental muscle of passing on setups. You develop the emotional resilience to see the market move without you and stay calm. That wait, that deliberate, disciplined, consistent wait, is where your genuine edge lives. That's where professional traders build wealth. That's where amateurs fail to look, because the action isn't there. The action is in the simplicity of waiting. Everything converges here in this final chapter where understanding becomes mastery. You now comprehend 4 essential truths: that speed destroys accounts through noise and false signals, that noise triggers catastrophic emotional responses and false signals, that confirmation protocols eliminate guesswork entirely, and that patience is your greatest weapon in the market. But knowledge without execution is merely theory. Theory doesn't build wealth. Execution does. Here's exactly how professionals build their sustainable 4-hour edge and transform from understanding into consistent profitability. First, commit to the time frame as an identity, not as an experiment. This is critical. Not I'll try the 4-hour chart for a few weeks, but I am a 4-hour trader. This is my identity. Identity precedes behavior. Behavioral psychology proves this consistently. When you own that identity deeply, it changes your decision-making at the neurological level. You stop scanning the 5-minute chart for better entries. You stop justifying quick trades based on emotional urgency. You stop fighting your own neurobiology because your identity is aligned with the 4-hour protocol. Instead of constant vigilance and nervous checking, you develop a calm routine. You check the 4-hour chart once in the morning, once at midday, once in the evening, 3 times. That's it. Your brain accepts this rhythm because your identity as a 4-hour trader makes it feel natural. An amateur who's trying the 4-hour chart will last maybe a week before reverting to the 5-minute. He'll rationalize it just this once, just for today. An amateur who's adopted the identity of a 4-hour trader will stick with it because it becomes who he is, not what he's doing. Second, build a repeatable checklist that becomes your gatekeeping system for every trade. Before every single entry, you verify 4 specific conditions without exception. Does price touch a pivotal point that's been tested multiple times? Review your chart history. Is this level where reversals have actually occurred? Not once, multiple times. If the answer is no, you pass. Do 2 consecutive 4-hour candles confirm the structure? This means 2 consecutive candles closing in your favored direction, showing genuine strength and respect for the level. If you don't see this, you wait. Is your risk exactly 1 to 2% of your account? If your account is $50,000, you're risking between $500 and $1,000 per trade. Not $2,000, not $500, somewhere in that band. If your stop loss creates more than 2% risk, you adjust your position size down. Is your target at least 2 times your risk? If you're risking $500, your target must generate at least $1,000 in profit. If your setup only offers 1.5 times risk-reward, you pass. This checklist becomes your mechanical filter. You don't think about it, you don't question it, you execute it. When all 4 boxes are checked, you enter. When any box is unchecked, you pass without hesitation. This checklist removes emotion from entry decisions. It removes your ability to rationalize bad entries. It removes your ability to override your protocol. Third, track your data obsessively, because data is where truth lives. A professional trader I consulted extensively, let's call him David, committed to the 4-hour protocol and tracked every single trade for 6 months. His discipline was meticulous. He recorded entry price, stop loss level, target, actual exit price, whether he won or lost, and the dollar amount of each outcome. In his first month, he took 9 trades total. Only 4 of those 9 trades won. His win rate was 44%, but his average winner was $3,200. His average loser was $1,100. His profit factor was 2.9. He made $7,900 in month 1. In month 2, he took 11 trades. 5 won. Win rate of 45%. His average winner had climbed to $3,450 as he fine-tuned his target placement. His average loser dropped to $950 as he refined his stop levels. His profit factor improved to 3.1. He made $11,750 in month 2. By month 3, the consistency was improving. 12 trades, 6 wins. Win rate of 50%. Average winner, $3,600. Average loser, $900. Profit factor 3.5. He made $16,200. By month 6, David's data showed profound improvement. His average trade count remained around 10 to 12 per month. His win rate had settled at 48%. His average winner had climbed to $4,100. His average loser had fallen to $850. His profit factor had reached 3.9. Over 6 months, he'd taken 63 trades. 30% won, 33% lost, but his total profit was $78,400 on his initial $50,000 account. He'd made 156% return in 6 months. The amateurs around him, the ones still chasing the 5-minute chart, were averaging negative $200 per month. David was making $13,000 per month on average. The difference wasn't intelligence. It wasn't market knowledge. It wasn't luck. It was protocol and identity. David had committed to the 4-hour time frame. David had built a checklist and followed it religiously. David had tracked his data and refined based on actual results. The amateurs had not. This brings us to the critical distinction that separates professionals from everyone else. Professionals are obsessed with their process, not with their results. David didn't obsess over whether he made money yesterday. He obsessed over whether he followed his protocol. Did he enter only when all 4 checklist boxes were confirmed? Did he size correctly? Did he exit at his predetermined target or stop? If the answer to all 3 was yes, he considered the trade a success regardless of whether it won or lost. This psychological inversion is powerful. It removes the emotional pressure of needing to win immediately. It removes the desperation that makes you override your protocol. It removes the fear that makes you exit winners early or hold losers too long. You're not trying to win the next trade. You're trying to execute your process perfectly. Winning becomes a byproduct of process excellence, not the goal itself. An amateur is obsessed with results. Did I make money today? If yes, he's happy. If no, he's devastated. This emotional volatility makes him impulsive. When he's devastated, he revenge trades. When he's happy, he gets overconfident. Both states lead to protocol violations and account destruction. When you shift your obsession from results to process, your entire trading career transforms. You become steady. You become disciplined. You become profitable because you're optimizing for consistency rather than chasing performance. Now, here's what separates David from 99% of traders who attempt the 4-hour protocol and fail. David made a decision about his environment. He deleted his 5-minute charting software from his trading platform. He set his phone to not display any trading data. He gave himself access to the 4-hour chart only, nothing faster. He created environmental constraints that made it impossible to override his protocol. Most traders don't do this. They keep the 5-minute chart available just in case. They tell themselves they have discipline. They don't. Within 2 weeks, they're back on the 5-minute chart during moments of psychological weakness. They're back to chasing setups. They're back to overtrading. David understood that willpower is limited. His environment needed to make the right choice the only available choice. This is why his protocol worked. The final maxim that summarizes everything you've learned crystallizes here. The 4-hour chart is where consistent traders are made. The 5-minute chart is where accounts are destroyed. This isn't hyperbole. This is fact validated by David's data, by Sarah's pass log, by Marcus's transformation, by Elena's structural change. Every professional trader you could study has abandoned the 5-minute chart. Not because they couldn't read it, because they finally understood the cost, the psychological cost, the financial cost, the opportunity cost of trading noise instead of structure. They understood that speed feels productive but destroys capital. They understood that patience feels slow but builds wealth. Your path forward is clear. You have the 4 pillars. You understand why speed destroys accounts. You understand the neurobiological mechanics of the noise trap. You understand the confirmation protocol that filters real setups from mirages. You understand the patience paradox that makes selectivity more valuable than activity. Now you must build your 4-hour edge through 3 actions. Commit to the identity. Build your checklist. Track why. Our data ruthlessly. That's your foundation. But there's a deeper skill that multiplies your returns exponentially. Position sizing during pyramiding. Understanding precisely when to add to winning positions, how much to add, and how many times to pyramid before taking profits will transform your profit factor from 3 to 4.5 or higher. This skill is built only after you've mastered the foundation you've just absorbed. Pyramiding without foundation is reckless. It's how traders blow accounts, but pyramiding with foundation, with ironclad protocol discipline, is how professionals multiply their wealth. The 4-hour chart awaits. The professionals are trading there, building wealth quietly, patiently, systematically. The amateurs are on the 5-minute chart, destroying their capital at high speed. Will you join the professionals? Will you commit to the identity? Will you follow the checklist? Will you track your data? Or will you rationalize just one more 5-minute trade? That choice, repeated daily, determines whether you become a professional or remain an amateur. The market doesn't care. The market will trade with you either way. But your account knows. Your future knows. Make your choice now.